Welcome to the Self-Storage Report. I'm your host, Chris Berg, do land acquisition for Abernathey Development. We got a very special guest today. I think I would dub him as sort of this historical behavioral finance person. Got an incredible background. Right now, he's the CEO and founder of what's called Lombard Equity Group. He's also going to write podcast out and a Substack, The Timeless Investor. We'll talk more about that throughout the show. He's an author. I don't know how he does all this stuff. He's an author, Timeless Wealth, Real Estate Through the Ages, which we're going to dive in today. Had a great piece on his Substack today about it. Private wealth advisor with Goldman Sachs. He was with Fisher Investments, and also a D1 athlete at UC Davis. And as he just mentioned before the show, also a father of four. How he's doing all this, I don't know. But Ari Van Gemeren, welcome to the show. It's great to have you.
Thanks for having me, Chris. It's a pleasure to be here.
I have so much I want to talk to you about because I really do enjoy your content. And I'm only chuckling because you and I had this great conversation before the show. And what I want to get at really is, so, you're at Goldman Sachs, Fisher Investments, I'm assuming very equities focused, but now you're doing real estate. Why that transition, especially knowing how much, I'm assuming you were looking at, the returns and whatnot in the equity class?
Yeah, well, it's a multivariate story. So when I was in equity research at Fisher, I was really bought into the firm belief and, public stocks all day long, liquid assets, which is a great investment. And you'll never hear me poo-pooing the stock market as an investment, unlike many of my colleagues in this business, who are real estate focused exclusive. But I was in equity research and I was a true heart believer in stocks. And a senior research analyst pulled me aside, who'd been there like 40 years. And he's like, "Hey kid, come check this out." And he had consolidated the returns of real estate over time. And he was like, real estate has outperformed the stock market like by a lot over this time period. And, we're saying all this stuff about stocks because that's what we invest in, but real estate's done really well. So that was the first light bulb for me. The second light bulb was my wife's family is Persian. And, not to make generalizations, but a lot of folks who immigrate to the United States are big believers in real assets, and they constantly acquire and they own and they don't invest in the stock market. And I used to go back and forth with my father-in-law on this. And so we bought our first place in the San Francisco Bay Area, a tiny little cottage, like 1,000 square feet for $500,000. And it was in the East Bay of San Francisco. And my father-in-law was like, "You have to buy this house. You're going to make a killing on it." And I was like, I'd rather have it in the index funds and the stock market, blah, blah, blah. Well, fast forward, we did like maybe $60,000 of work on it. We added a bedroom, we built a second bathroom, and we added a garage. Did it really inexpensively. My wife and I lived in it like a live-in flip with billowing, tarps and dust everywhere. And the home reappraised for $950,000 after that work. So I bought the home with maybe 120 down, put $60K into it, and quadrupled my money. And I was like, oh, this is very compelling. I can't do this with stocks. And picking a stock is a difficult business to produce abnormal returns. And we took that money, we refinanced out of the house, and I went with that and I bought several more apartment complexes with that money, did the same value add improvement, and then refinanced out of those and kept buying apartment complexes with the money. So I was completely sold. That whole time I was at Goldman. So I was a private wealth advisor at Goldman, and I had the privilege of meeting incredibly wealthy individuals all across the Bay Area. But the ones that really stood out to me were the real estate guys, right? And there was one gentleman that stood out to me who was a very well-to-do tech founder, but he was a Middle Eastern guy. And, he said to me, "Ari, my business makes great money, but I was always taught by real estate. And from the day I came to this country, I just bought real estate. And today my real estate makes me more money than my tech company. And I don't have to work if I don't want to because I have this portfolio." And all this was in my head. And so eventually I said, I got to move on from the investment management world. I got to get into the real estate business. I've been doing it on my own account. I'm ready to go big with investors, do something bigger, and kind of follow the same tried and true strategy. So it was a 10 to 11 year transformation from all in on stocks to now, like, our family assets are 100% in real estate right now, which, arguable if that's a good choice, but that's where we are today. So.
Well, and I appreciate you being so frank and candid, because that was actually where I was going is, okay, that was great. I was curious when you had this conversation with this gentleman. I think you said it was at Fisher, right? When he said, "Hey, real estate's actually performed better." When was that conversation? Because we come out to today with the whole AI boom and the Mag 7, and there's been some pretty hefty returns in the equity arena. And so I'm just curious, comparing today, would you include today and still say real estate's performed better or no?
Yeah, I mean, it's interesting. So that conversation was in 2013. So that was encompassing the very bad drawdown with 2008 for stocks and for real estate. So real estate did really well from 2013 through 2023. And then obviously we are in a bear market in the asset class right now. So, you know, stock market is a leading indicator of kind of what's happening in the economy. And the stock market, at least right now, is at an all-time high. And real estate is quite low at the moment. So I actually remember a good conversation with a client saying, hey, the stock market's way down. How's real estate doing? And at the time, this was maybe in late 23, I said, well, as of now, values haven't really declined yet, but it's coming. And it did come. And so at this point in time, I think the opportunities in real estate personally, because you have an all-time high stock market, arguably I would say in bubble territory at this point, as judged by any number of, metrics by which one analyzes the stock market. The real estate is in a bear, in a deep bear. And so you're seeing really good opportunities to buy stuff at substantially reduced bases, but they don't track each other perfectly. So stocks are here, real estate's now here. It used to be like this. This was the time to buy stocks. I think now is the time to buy real estate.
So let's get into where you see things are and where they're going. I want to do this. Thaddeus Campbell and I, co-host this show, the Self Storage Report. You and I actually talked about this book in our initial conversation a while back, but The Secret Life of Real Estate and Banking. He talks a lot about this 18.6-year real estate cycle. I don't think you read it because you and I said it's pretty arduous and you have a lot on your plate.
Yeah.
But if you remember, the thesis was essentially he's saying, hey, what the thesis is suggesting is probably mid to late 2026 is when the land market really starts to go down. Are you familiar with Henry George? You and I talk about Henry George when we spoke the first time.
I
So
don't recall. Yeah.
famous economist back in the late 1800s, ran for the mayor of New York. But his premise was when you look at economics was land, capital, and labor, right? And since then, they've really stripped out land. No one really monitors land. He's like, when you really, even Peter Thiel these days, speaking about tech guys, is starting to look at Henry George and go, look, ultimately land takes all the gains. Like they get all the rents. And so I say all that because if you get such an incredible historical background, I love what you're doing. One, do you concur with sort of this mid to late 2026 thesis around land prices start to go, the banking system starts to see some, fragility and things maybe are even worse than 2008? Or what's your thesis at right now?
That's a big question. So I think there's a couple factors kind of hitting at once. And there's a bunch of different variables that you got to build into this thing. So first of all, the entire world has converted to a fiat economic system, right? And so every single country in unison is printing money, monetizing debt, which is driving the value of currency down, right? One of the reasons you've seen gold have this absolutely unbelievable run. So you talk about the stock market returns, gold has outperformed the stock market dramatically over this period of time, right? And I don't own a lot of gold. It's not a huge part of my thesis, but you could argue that gold's rising price is indicative of disbelief in the economy, right? A belief that currency is being devalued systematically across the West and the East, right? I mean, it's not like China doesn't also print money. Nobody runs a sound economic currency system anymore. Historically, that correlates well to land and assets holding value. But there's caveats to that, right? We don't like real estate itself doesn't perform great in an economic collapse scenario either, because you still have the business pressure in a collapse scenario affects real estate just like the stock market. Residents have trouble paying rent, businesses are closing, this sort of stuff happens. But historically, real estate is a fantastic hedge against inflation and against debasement. In every single historic instance of heavy debasement, landowners come out ahead and do well in that scenario because the value of land jumps dramatically. So I don't know. I think there's a lot more pressure in the system than people really respect or see. There's a worrying degree of movement by politicians, and this is not to blame politicians. This is the way politicians operate. It's easier to cause inflation, to print away problems than it is to make sound economic decisions. And we're not able to do anything about what the government wants to do. And everybody's doing it in tandem. So the only thing investors have to ask themselves is, how do you protect yourself and your family? To me, that's hard assets. It's either real estate in supply constrained locations. Gold is a good hedge, has been a good hedge. Some folks like Bitcoin. I'll withhold my judgment one way or the other on the asset class. But I do think there's something coming down the pipe that's not going to look great for our. I think there's going to be a moment where we have to figure out what to do with our growing debt pile. And the US government's ability to service its own debt, our debt cost is rising and rising. So yeah, I do think that we are entering a period where hard assets, business ownership, real equity in companies is going to be more and more valuable for the time being.
So what do you, because you did a really good piece on the 1866 bank run. I think you called it Black Friday. And I love how you sort of set it up like, hey, something happened in January of 1866, but that was just sort of a catalyst to what really took place. I think you said in May. And it's always one of
Yeah.
those situations where you may not see it. And all of a sudden you're like, oh, that's what it was. Again, this is all sort of a guesstimation, but what do you see coming on the pipeline? Or maybe it's a regional bank thing or whatnot that you think, hey, this could be the catalyst, Chris. It starts to cause some real structural changes or challenges within the banking system.
Yeah. So in the history of economies, and one of the major trends that we focus on a lot on the Timeless Investor is the rise of shadow banking. Shadow banking being unregulated financial activities that are kind of outside the view of government regulators. And I'm not saying this to say government regulation is a good thing, because we, the royal we, will always find a way to circumvent regulation and put capital to work where we want to put it to work, right? And so the Panic of 1866 piece you mentioned was a good example of this. It was an unregulated financial system, and Over in Gurney was one of these blue chip top tier banking houses, and they started taking on more and more dangerous style of investment, unbeknownst to the public that was investing with them. And those investments started to fall apart. And you had mentioned, Chris, that oftentimes these collapses are catalyzed by something sort of unexpected outside the periphery happening that punctures a hole in the story. And that's what happened with Over in Gurney. A completely unrelated bank failed for a different reason, and then there was a cascade effect, and then Over in Gurney fell. So shadow banking is observable as a trend throughout most of human history. Unregulated finance, people searching for ways to make capital. And so the question is today, what is our version of shadow banking? Because it happens over and over again. And I would argue today is private credit. So private credit is billed as a riskless way to make money. You have good collateral. There's no risk. You're going to get good money on it, which is basically the argument of every financial product ever pitched to anybody by Wall Street. This is the one. This one's going to get you a great return, and there's not going to be a lot of risk. And private credit is exploding. Huge industry. It's starting to get a lot of conversations. And what's more concerning is historically the investors in private credit were institutions, but institutions are starting to actually back away from it. So now, with the aid of a pro-business administration, they're pulling back some of these safeguards for private investors, and now they're coming after private investor capital, talking about private credit going into your 401k plan. It's just a massively growing space that, like every single situation before, is billed as a riskless way to make a return. And so you can see it with the collapse of some of these subprime auto loan groups, which kind of falls in that same space, which could be the catalyst. And these things take months. So it's not like this happens and then it immediately happens. But there's weakness here, and then it starts to spread. And if you think about it, much of the private credit world is investing in businesses, but businesses are highly exposed to the economy. And as we just saw with the payroll numbers and everything coming out, I wouldn't say that the business system is doing great right now. There's a lot of pressure coupled with rising debt burdens for those businesses. And there's private credit on top of it with tons of capital flowing into it. It could be the catalyst. It could be. It might not be, right? I don't want to sit here and talk, Chicken Little with the skies falling, but it could be. Like it has the components of being something kind of nasty.
Yeah. And I think people that watch this show regularly, fairly adept at this 18.6-year real estate cycle. So again, if we go out to the 26, late 26, and this thing comes to fruition, you start to see some cracks in the system. I think obviously what's going to be fascinating is just with AI, potentially profits could go up. So stocks can continue to buoy the system a little bit. But with all that being said, like, let's just speak to the average person watching the show. You've got this incredible background and, private wealth. Again, this isn't investment advice. I want to be clear on that. But then if you were going to be a CIO, like, what would you be doing right now to sort of hedge and protect and manage your investments and mitigate risk?
Yeah. Well, the classic answer, if you think something bad is happening, is to be in gold or cash, right? I mean, that's like the baseline scenario. As a former private wealth advisor, I would never suggest someone go to cash for a variety of reasons. Could be wrong, and the market could rip, right? There's a really great data point on what would have happened if you bought at market peak as a constant investor over time in the stock. We're talking about stock market right now. And your returns are not that different over the long term versus if you were to capture the lows in the market. So people are really fixated on what's the ultimate level of the stock market. So I say that to say I would never suggest someone go to cash, right? Like I would add that if you anticipate inflation is going to rise, cash is the worst place to be. It's actually not a very riskless place because you lose money every single year on your money. So I would propose a defensive oriented portfolio. Gold is interesting. I mean, it's a classic defensive hedging asset class. However, it's at a very high point right now. So I don't know that gold is necessarily riskless at the moment. Certainly never riskless. Broadly diversified. I don't think you'd want to be in bonds right now. I think bonds are if inflation goes up, there's a real risk that bond rates go up. And as the listeners most likely know, just like real estate, if the yield rises, the value falls, right? So, and if inflation goes up, bonds will have to rise to provide a real return to investors. So, our strategy with our firm has been to, again, I think real estate's a good place to be right now for a variety of reasons, but there are certain asset classes within real estate that are trading at very low values at the moment. So you could pick up really good deals, put conservative debt on them, and hold through conceivably anything that comes up. I have a mentor in the real estate business who's been 53 years in the trenches, been through, I think, 6 different cycles, and he never lost a dime in real estate. And I asked him, what's your strategy? And he said, good real estate, good locations, and I never took as much debt as the bank wanted me to take. Because those 3 kept me safe my whole career, and I've never had to turn a building back to the bank or even do a capital call, because the lender would be like, "Oh, your building's great. We can give you 70%." He'd be like, "I'm good with 50. Make it 50." And he's willing to accept a slightly lower return to stay alive. And I really think if you look at the history of big real estate investors over time, the ones who survive are the ones that were conservative with their risk taking. They didn't go for the home run on every single at bat. And like, that's the name of the game, right? I mean, at the end of the day, the ones we talk about are the ones that survived. And the question is, why did they survive? Right. And it's not the alpha male building a huge building at the worst possible time and pouring everything into it and then going bankrupt, which is happening, unfortunately, to a lot of people right now.
So you mentioned some different asset classes. You're predominantly multifamily, I think, if that's correct.
Correct.
What are the asset classes? You're like, hey, Chris, this is where I think there's some real opportunity. And as you know, we're in self-storage. So I'm just curious your take on what you're seeing in that particular asset class right now.
Yeah. Well, the self-storage thesis is interesting. And I'm not a self-storage guy. And I don't pretend to know a lot about it, but I did just interview an amazing guy, Brad Minsley, who I hope you have on your show really soon. An incredible individual. The story in self-storage is pretty well laid out at this point, right? You have a lot of mom and pop owners that are transitioning out. There's smaller buildings, and there's an opportunity to consolidate those assets. There's also a major operational opportunity in self-storage, from my understanding. So many self-storage facilities haven't really leaned into AI, remote systems, remote locking systems. The average, this is back of envelope math. I don't know the numbers exactly, but your average REIT has 3 employees per self-storage facility. If you can just own an asset and drive the number of employees that actually has to run it down, massive improvement, right? And if you can buy from a mom and pop in a small rural market that doesn't have access to other self-storage facilities, then I think that's the name of the game, right? Mm-hmm. Developing a really strong operations ecosystem, drive down the costs, and then hold that thing. That to me is the self-storage play. I mean, I am interested in industrial. So one of the timeless principles that I've seen across time and different big owners across time is owning the boxes where people put stuff, whether it's self-storage or it's industrial warehouses or other facilities, is sort of a timeless principle that works incredibly well. So I wrote a piece about the Hanseatic League, which is kind of an incredible, I'm partially German. So, it's an incredible German story of like this crazy confederation of cities that aggregated merchant assets across the Baltic seas and controlled the warehouse facilities across 200 different cities, starting in around 1200 AD and ending around 16 to 1700 AD. And that story of owning critical infrastructure that is necessary and in prime locations repeats over and over and over again. So in some ways, I sort of kick myself for getting into multifamily. I should have been a warehouse guy, but I think the story applies to multifamily as well, especially in supply constrained cities. But depending on your thesis for what the future of trade looks like, coastal city warehousing facilities, coastal city industrial could be an interesting play. And I would say right now it's probably very depressed because trade is down. So it might be, I don't know my space, but it might be an opportunity to pick up infrastructure assets that will last for the long term.
Can you back up to that story a little bit? Because I saw snippets of what you're talking about. And then if I remember correctly, you said, hey, these guys ran an incredible business for like 500 years, right? It was just an incredible timeline. And I don't remember your name, but merchants running kings but it was a really fascinating
when
way.
Merchants defeated kings. Yeah, it's an unbelievable story. So the story begins. I'll do it quickly, but the story is in 1100 AD, Europe was a mess, right? There are Vikings, you've got pirates, you've got rogue states. Getting your goods from like Russia to London, very difficult. Very likely you die. And so it started with a confederation between the city of Lübeck and Hamburg. The merchants in those cities made a deal that they would work together. And it grew into a huge chain of merchants that would start to build warehousing facilities in prime choke point locations. And the whole catalyst for the whole thing was herring, the fish that comes out of the Baltic Sea. So herring was an infinite resource in the Baltic Sea, provided protein, was easily storable. The Catholic Church mandated meatless Fridays and meatless periods of time. And so there was and it was oil. They also used it as oil. So it was a incredibly important resource, but it was hard to move it around. So the Hanseatic League was a conglomeration of merchants that aggregated capital to buy the storage facilities. And then they would control all the choke points. And then when merchants would come, they needed a place to store their goods. They needed security and protection on moving their goods between places. And so the Hanseatic League controlled that infrastructure, and they never sold. So they worked together as a league. They had communal ownership. Nobody was ever allowed to sell, and they would produce dividends based on the warehousing, the protection duties, the different things that went into it. But they were so powerful that the king of Denmark at one point tried to tax the Hanseatic League on goods passing through. The Hanseatic League, a group of merchants, organized a navy and army group, assaulted Denmark, defeated the Danes in a naval combat, and then sacked Copenhagen. And for 70 years afterwards, Denmark could not crown a king without the Hanseatic League signing off on them doing it. So my point is, most boring strategy imaginable. Let me own the boxes where other people put their stuff. I don't even own the goods. I just own the box and the trade routes. Was powerful enough to overthrow kings. And they also had a war with Poland. They won the war with Poland. They fought England at a time. They also beat England. And many of their sites still stand today as UNESCO World Heritage sites all around the Baltic. So it's a really incredible, timeless story of why it pays to own good assets and good locations at choke points for trade.
Boy, that is a great story. So thank you for sharing that.
Sure.
That, in our show notes here so people can check it out. I'm curious, again, obviously you've got this incredible historical background when it comes to finance. What do you see based on where we're at today and where you believe we're going here in the next 18 to 24 months? Like, what's the best analogy to, hey, Chris, this reminds me of the 1970s. This reminds me of 1866, or what area do you think we're in right now and why?
Well, unfortunately, I think we're looking very similar to the pre-World War II era. And I hate to say that, but I think it's true, right? They have a couple factors that are very alarming. And I talked about this a lot in my writing. So when wealth inequality gets to a level that's unsustainable, you have the rise of very extreme political philosophies. The last time wealth inequality was as high as it is today was 1929. So And I'm not going to say we're going into a Great Depression, and I hope to God we're not going into another world war, but we are definitely leaning into more extreme political philosophies on the right and the left. And I would say a large part of that is a component of rising wealth inequality. I really feel that when people feel like the system is leaving them behind, they make a move politically to do something different. So again, 1929 gave rise to fascism, to extreme kind of virulent communism, to very extreme political philosophies in the United States as well, right? And much of Western Europe could have easily voted for communist governments around this time because wealth inequality was really high. And the driver, in my opinion, from what I've researched, is, in my opinion, fiat currency and currency debasement. So currency debasement disproportionately benefits asset owners and business owners. You had it in Germany, obviously with the Weimar Republic and the predatory kind of reparations that the Allies demanded from Germany, which caused the we look at the rise of Hitler as a good example, right? Hitler rose out of a system that enabled him to rise because the currency was so debased that people would do anything to change the situation, right? And that was happening all over the place. You had inflation rising, and then obviously you had the Great Depression, which struck around the same time, which was a function of like excessive debt levels. And so today, the parallels are sort of uncanny. So we have rapidly debasing currency. Asset holders have gotten very, very wealthy. We have very much rising wealth inequality. And there's a lot of really good charts on this topic. But if you look at what it takes for an American to buy their first home, and I look at this as a rough, there's obvious like real levels of wealth inequality we can point to. But owning your own home is like the number one way to build equity, to build credit, to be a part of the system and feel like the system is working for you. And the time it took for an average American to save to buy a home in 1970 was about 2 years. 2 years of saving to buy a home. It is over 7 years, in some cases much higher, depending on where in the country you live, to buy a home today. The amount of time you have to work to save for a home. So what is that saying? That is saying the dollar has gone down in value. Wages have not kept up with asset prices. All that's happening. And it's been happening since Nixon broke the gold standard, right? And was that necessarily his choice? Not really. There was a lot of other factors to it, but we did do it. And since that happened, this has happened. And what I feel like we're seeing today is rising political ideology on both sides that are diverging further and further apart, which is very alarming. It's a very alarming scenario. And so unfortunately, I'd say 1929.
Yeah.
I think it's the parallel.
And I like the way you framed that. There was a great email, I think it was in 2020, that Peter Thiel sent out to like Zuck and some other guys saying, hey, look, when people can't afford a house and they can't actually be part of this capitalist system, then they're just going to sort of throw in the towels and go, give me something else. I think that's what you see what happened in New York City.
That's exactly what happened.
And I think that's potentially what you could see here going into 2026. That's why I've got this uneasy feeling about 2026. Have you read the book, The Fourth Turning by Neil Howe?
No, but people tell me I should all the time. I've been told I have to read it.
Like, please, because he's got this great, and you appreciate this sort of cyclical way to looking at history, right? And he says, hey, look, every 80 years since really the first revolution here in America, then you had the Civil War, then it was World War II, and now we're coming up on the 80-year timeline where it's probably going to be some sort of world war. Now, whether that's a hot war, a finance war, we'll see how that bears out. But it's pretty clear. Even it's so fascinating, Ari, because I just want to put a button on that. We're probably headed into some sort of war, in the next, I would say, 12 to 24 months. Again, I pray that doesn't happen, but just based on what is going to take place with money. Do you ever see the video, All Wars Are Banker Wars?
Yeah.
Yeah. So there you go. When you talk about what we're doing with the currency here, and it was fascinating. I was at a self-storage event in Vegas early September, and we had this group of Christians come together on, like, it was Thursday morning, just to get together and kind of pray about the industry and this and that. And we're sitting there, and all of a sudden the Lord's like, hey, you really need to pray for the Federal Reserve. And I'm like, I've never done that before in my life, right? But that's where my heart's at, where I can see, I think, what is it, 87% of the assets now are owned by the top, maybe 10% of the people. And there's just all this distribution where, gosh, if you're 24, 25, you're like, why would I want to be a part of that system? It's completely broken. It's done nothing for me.
Yeah. No, exactly. It's ironic. The only limiting factor today is nuclear weapons. So if if we didn't have, I mean, it's kind of a crazy thing to say, but if we didn't have nuclear weapons, we would have had a hot war with the Soviet Union. There is no question. We would have had a war with them. Europe would have been ravaged by war with the Soviet Union. If we didn't have nuclear weapons, we would be fighting Russia right now in Ukraine. It is one of these great ironies of history that this weapon that has the capacity to destroy the entire world has actually minimized death in war since World War II dramatically. Yeah. So the pressure valves, unfortunately, fall on the third world, which just end up hosting proxy wars between the major countries. And you're seeing it in Ukraine. It's probably going to happen in Taiwan. It's probably going to happen in Venezuela. And like these wars are happening in places where nuclear weapons can't really be used. So that's how we fight. So hopefully that holds it off.
I think that's a fair war thing, especially if you go back to the, all wars are banker wars. But I think you could almost use that third world term. I think the debasement of our currency, if you were to go talk to some 20-year-olds right now, they wouldn't say America's a third world because they probably don't have the reference, but I could see where they could easily make that argument, right? So the debasement thing to me seems almost like the war that's being fought, which I guess I want to get your thesis on this. And, again, what's going to be this catalyst? Do you think data centers could be a catalyst to this next unraveling? And or, you talk about the currency piece, but then I don't know how much you've been following the Genius Act and stable coins, where you've got Secretary Bessent suggesting, hey, stable coins is going to save the dollar. It's going to, cause more proliferation of the USD. Just what are your thoughts on that?
Yeah, well, you mentioned data centers. It's actually a really interesting point. So I'm working on a piece right now comparing basically every infrastructure boom. The first generation builders of the infrastructure boom are not the ones that make money. It's the second and third owners that take it over from the now bankrupt infrastructure builders that actually make money. So, and if you look at the history of infrastructure buildouts, the railroads, fiber optic cables in the 80s and data centers today, they all follow a very similar trajectory. And except that data centers as a percentage of as the amount of money flowing into data centers as a percentage of the GDP compared to previous infrastructure booms is a magnitude higher, much higher. Like 14% of the GDP is being projected to go into building data centers. Is OpenAI, I think I just saw this stat. OpenAI just pledged to invest like $1.3 trillion into data centers. With what money? Where's the money? And you just mentioned before the call about them asking for money from the US government. Like, is that why? Probably, right? Because how are they going to bankroll that?
Especially, I think, what is it, $13 billion they're doing annually in revenue? It's like, come on. So I guess I would love to get your thesis on that, because, now OpenAI is coming to the government saying, hey, you need to back us, which could be the downfall of a lot more than just some, private credit guys.
Well, yeah. And the other question is, I think the government is likely to back them because OpenAI can probably portray it in terms of a national race with China and say, you have to put money into this. But then the question is, where does the government come up with the money for it? And the answer is print money, as it always is. Now, do we need the infrastructure? Probably, right? But the question is, what's the short-term ramification of this massive build out on an industry that's sort of not really proven yet? Like, OpenAI is an incredible company. I use it all the time. I use all these different tools all the time. They're great. But is there a there, or is it, are we like 1999? It reminds me, like, we used to say when I was in equity research, every bubble has something about it that's true. Like it's a valid thesis, right? It's just that we are ahead of where the value needs to be at that time. The 1999 late tech bubble wasn't wrong. It was just early. A lot of money went into tech. It was proven right. Like eventually it was proven right, but like those people still lost their shirts on that round. I would venture to guess that's where we are with AI. Like obviously it's a great technology. There's a great and clear use case, but there's, irrational exuberance, to quote my man Greenspan.
And just put a button on this, and then we can kind of wrap things up. But also you look at, we just talked about the job numbers here in October. Decimated as far as what's going on with hiring. There's going to probably be more unemployment because of AI. And then what do you do when no one can afford their power bill because power continues to skyrocket?
Yes.
It's just a really weird dynamic, right? So I guess what I'd like to do is just put a bow on this conversation, because you and I could dance in a lot of different directions. But just for the person watching, like, how would you sort of sum up this conversation and say, hey, being in your shoes, these are some things you want to be aware of, again, to mitigate risk and keep your assets.
Look, I think the whole premise of what we do, obviously I run a real estate investment company. We are believers in acquiring real assets long term. But the whole premise of the timeless investor, which is our, digital brand and our voice in terms of tying historical events to modern day affairs, is this. I like to quote the Bible on this. Like there's nothing new under the sun. Nothing. Everything has been done before. We've seen everything before. There's really nothing that's truly new and unique. I suppose the counterpoint to that would be nuclear arms. But nonetheless, generally speaking, economic cycles have all happened over and over and over again. And the premise, go ahead.
I just love what you talk about. The reason that these cycles happen over and over again is why?
Human nature never changes. And humans are the driving force of history. So as long as human nature doesn't change, and I get a kick out of our modern world because I think we often think we are superior and better today. Arguably, we're better educated to an extent. I would argue, classical Romans were well educated as well. We are not that different from people that lived 5,000 years ago. Our motivations are not that different. Our ambitions, our desires, they're not different, right? And we made the comment on shadow banking earlier. Like, we will always find a way to circumvent systems. Nothing has changed. And so there is nothing new under the sun. Things repeat. And the whole premise of the timeless investor is that, and that if you look at history, you can glean the right way to protect yourself and build wealth in most scenarios by those who have gone before or those who are currently doing it. So I mentioned my mentor with his rule on debt utilization and real estate. I mentioned the Hanseatic League. You can look at the Grosvenor family in England as another classic example, 380 years owning the same properties. You can glean from history what it takes to survive most economic scenarios. You could even glean from history what it takes to survive imperial collapse or national decline, right? Which I'm not saying we're going into. That's a very bad case scenario. But you can figure out through timeless principles what it takes to survive. And the general answer is be conservative, don't overuse debt, buy real assets, protect yourself against currency debasement, and do the right thing. That's my list. But I think it's echoed by history and echoed by great builders across time.
You kind of just answered this question. I got two more questions for you, but you said you have 4 kids. Do you have any sons?
3 boys.
3 boys. Okay. So something I'm really passionate right now is I am doing a lot of work with young men in that demographic. If you look at the research right now, I mean, the data is horrendous from an education standpoint, financial standpoint.
Yeah.
A lot of them moving back in with their parents. So again, because of your experience, what you've done within private wealth, your background here is studying economic history. If you were going to sit down with a young man right now, say he's watching the show, what would you say to him in regards to building his future and especially his financial future?
Yeah, I mean, I'll echo a quote my dad told me when I started off in the work world, because I had a low income in the Bay Area starting out, and it was kind of tough. And he always said to me, "Don't worry about the money right now. Worry about learning and getting better at what you're doing, and the money will come." Right. So I said before on my timeless principles, like, do the right thing, be good. I think there's a lot to that. I think we have a world today which really prioritizes short-term wins. I love to reference the Colonel of Kentucky Fried Chicken. I mean, he started that business when he was 68, and I believe the reason was he couldn't cash his pension check, so he had to figure it out. Like, we're so used to seeing young people make exorbitant amounts of money really quickly that we forget that that is not really normal. And it's still not normal. Most wealth is built over time with patience, wisdom, and accumulation. And take the long view. I would say take the long view always, 100% of the time. That'd be my advice. And that's what I tell my kids.
So good. Last question. You mentioned the Bible a moment ago. One of the things I wanted to ask you is just how your faith fuels your business. How does it impact your business?
Yeah. Well, I'm Catholic. So I have a healthy degree of Catholic guilt in my life. I think we do a lot of service work in our community. I've spent a lot of time with the church, feeding homeless people, talking to them, giving them the gospel, doing whatever I can to help them on the streets. And you see real deprivation and struggle in people. And so, my faith has given me a lot of belief that like our job is not just to do well for ourselves, but to do well for others. And I don't mean that in a trite way. So like one of the manifestations for us is we try with our buildings to also serve our residents as much as we can. So like, for example, we just rolled out a new program to help residents build credit, right? So if they pay rent on time, they can build credit. Hopefully they can go buy a home. We can help turn this cycle and start helping non-homeowners build credit. That a lot of that is informed by faith, by a belief that like we should treat one another as brothers and sisters, and no one is better than someone else. We're all in this together. I try to treat our compatriots and partners that way, and a lot of it's informed by my faith, right? And I think the Catholic Church in particular is a big proponent of like universal brotherhood, like we're all together, and so I really feel that in our day-to-day work, and we try to emulate that with our residents as well.
Ari, great stuff. I want to give people a chance to find out more about you. So let's see if I can get this and bring this up for people. If you want to check out his Timeless Investor, which you just heard there, I mean, fantastic content. There's the URL to do that. Also, if you want to find out more and reach out to him at Lombard Equities, I'm assuming they can just go to that website and email you, Ari.
Correct. Yep.
Fantastic. Anything else you want to add or share, sir?
Not at all. It's been a pleasure being here, Chris. This was a great conversation, and I hope the listeners found some value in it, and I look forward to coming back on at some point in the future.
Me too, man. I got a ton of value out of it. So whatever you shared was fantastic, and we'll definitely do this again and keep up the great work, and thank you.
Awesome. Thank you so much.
Thank you. The Self-Storage Report, I'm Chris Berg. We'll see you back here very soon.